Okay, so what if I told you that one of the absolute best ways to invest has nothing to do with being a genius? In fact, it has everything to do with the simple, stubborn persistence of a guy like Forrest Gump. That's right, today we're going to break down Gump investing, a surprisingly powerful idea that shows how sometimes the simplest path is actually the one that makes you the wealthiest.
I mean, seriously, does investing ever feel just impossibly complex? Like you need a PhD just to understand what's going on? You've got all this jargon, crazy charts flying at you, and gurus on every corner telling you they have the secret? It's enough to make anyone feel overwhelmed, or maybe just too scared to even get in the game. But what if the real secret wasn't about adding more complexity, but taking it all away?
All right, so let's talk about investing's three great enemies. See, that feeling of complexity, it's not an accident. Before we can really get to the simple stuff, we have to call out the things that make it so hard. And these enemies, they aren't some external market force. Nope, they're actually powerful emotions hiding inside every single one of us.
And here they are: greed, fear, and impatience. It's this vicious, toxic cycle, right? First, greed kicks in. You see a stock that's going to the moon and you just have to have it, so you buy at the top. Then what happens? The market does what it does, it dips. And that greed instantly flips into pure fear. You panic, you sell, you lock in a loss. And then comes the final blow: impatience. You get frustrated, you ditch your whole long-term plan because you're just desperate for a quick win, and you end up missing out on the slow, boring, steady growth that actually builds wealth. This emotional roller coaster, that's the reason most people actually end up underperforming the market. So, let's get to the solution: the Forrest Gump philosophy. The big question is, how do you fight those enemies we just talked about? Well, you don't fight them with more charts or more data. You fight them by starving them. The Gump philosophy is basically the ultimate countermove. It's a strategy so simple, so disciplined, that it gives greed, fear, and impatience absolutely nothing to grab onto.
Yeah, it's really all inspired by this one idea: persistence and simplicity. I mean, just think about Forrest Gump for a second. The guy achieved these incredible things, not because he was a genius, but because he had a simple plan and he just kept running. Well, this investing approach is exactly the same thing. It's not about trying to be the smartest person in the room. It's about being the most consistent, the most stubbornly disciplined.
So the engine behind this whole philosophy is something called passive investing. What does that even mean? Well, think about it like this. Instead of spending all your energy trying to find that one magic needle in a haystack, that one perfect stock, you just buy the whole haystack. Simple. You're not picking stocks, you're buying the entire market through something called an index fund. And then you just let time and the natural growth of the economy do all the heavy lifting for you.
Okay, so let's get into the how. How do you actually put this into practice? Well, the whole thing boils down to three really simple, really powerful rules. Seriously, anyone can do this.
All right, rule number one, and this one is such a relief. No market timing, no obsessive watching. I mean it. Stop trying to predict the future. Stop wasting your brain power trying to guess the perfect day to buy or the perfect day to sell. And, this is a big one, stop checking your portfolio every 5 minutes. This rule is designed for one reason: to save you from that emotional roller coaster of greed and fear. Now, you might be thinking, but timing has to matter, right? Well, check this out, because the data tells a really interesting story. Let's imagine two investors over a 20-year period. Investor one has perfect timing. I mean, they buy at the absolute bottom of the market every single year. A genius! Investor two has the worst luck in the world. They invest their money at the very peak of the market every single year, right before a drop. So, what happens? Well, yeah, the perfect timer ends up with a bit more. But the unlucky investor, they still build a massive amount of wealth. The takeaway here is incredible. Just being in the market consistently is so much more important than trying to time it perfectly.
Okay, so rule number 2, focus on index ETFs. If we're not picking individual stocks, what are we buying? The answer is simple. You buy the whole market. You do this with something called a broad index ETF. The most common example is a fund that tracks the S&P 500. Just think about that. It's one single thing you can buy, and it automatically holds a piece of the 500 biggest companies in America. With literally one click, you own a tiny slice of Apple and Microsoft and all the rest. It's instant diversification. It doesn't get much simpler than that. And that brings us to rule number 3, which is honestly where the real magic happens. Let time and compounding do the heavy lifting. All you have to do is be patient and let the power of compounding take over. It's that classic snowball rolling downhill, At first, it's tiny, but pretty soon, the money your money earned starts earning its own money. And over a few decades, that little snowball turns into an absolute avalanche of wealth. It's an unstoppable force.
So, how much heavy lifting are we talking about here? Well, look at this number. Over the last 30 years, the S&P 500 has had an average annual compounded return of about 10.8%. That's the engine, right there, working for you in the background while you're out living your life. And this really gets to the core of it all. Your biggest, most powerful asset as an investor isn't how smart you are. It's how much time you have.
Okay, so let's move on to answering your biggest fears. Because I know what you're probably thinking. This all sounds great, but the real world is crazy. What about a massive market crash? What about inflation? And look, those are totally valid fears. So let's hit them head on.
So let's ask a fundamental question. Where is your money actually safer? On one hand, you've got a bank account. It feels super safe, right? It's predictable, but every single year, inflation is quietly eating away at its value, so your money buys less and less. On the other hand, you have index funds. Yes, they're going to be volatile in the short term, there will be ups and downs, but over the long haul, they have proven to be a way more powerful tool for actually growing your wealth and staying ahead of inflation.
All right, let's do a little rapid-fire Q&A. Question 1. What about those huge, terrifying market drops? The simple answer? They are fantastic buying opportunities. You have to change your thinking here. A market crash isn't a fire you run from, it's a flash sale. Everything's on discount. Next question. When is the best time to start? The answer is always, always as early as possible. The more time you give that compounding snowball to get rolling, the bigger it's going to get.
Okay, finally, let's talk about playing the long game. Because this isn't a set it and forget it forever kind of deal. It's more like a set it and then adjust it as your life changes. The strategy is meant to evolve right along with you. And the principle here is really simple. Your timeline should dictate how much risk you take. So when you're in your 20s and 30s, you've got decades ahead of you. You can afford to ride out the market's ups and downs, so you're going to be heavily invested in stock index funds for maximum growth. Then as you get into your 40s and 50s and start approaching retirement, you're not panicking and selling everything. You just gradually turn down the risk dial. You start shifting some of that money over to more stable things like bonds to lock in and protect the wealth that you've worked so hard to build.
So let's just end with this one question. Because this whole philosophy, really, it's all about a trade-off. You're trading the nonstop stress of trying to be a market genius for the quiet confidence that comes from a simple, proven plan. So you have to ask yourself, if you just stop trying to outsmart the market and instead you just let it do the work for you, what could all that patience, all that simple persistence really earn you in the end?